All right, let's get right into it. Today, we're unpacking a really compelling analysis from economist Peter Schiff, and he's raising some big questions about the true cost of a new war. He's connecting some very interesting dots here between the national debt, some wild market swings, and the way modern wars get funded. So let's break down exactly what he's saying.
So where does this all start? Well, it kicks off with this one single quote. According to Schiff, the Treasury Secretary is on a Sunday morning show and gets asked a pretty basic question. How are we going to pay for a new war? And the alleged response was, that's a ridiculous question. For Schiff, that's the giant red flag. That dismissal of such a fundamental economic question is really the starting point for his entire critique.
And that really begs the question, right? Why was this being asked in the first place? Well, according to Schiff, it's because there were rumors flying around about a massive new spending request to get the military action funded.
And we're not talking about pocket change here. The number being thrown around was a whopping $200 billion, a huge extra appropriation for the war. And yet when someone dared to ask, hey, how are we going to pay for this? The initial reaction was supposedly just disbelief, as if, why would you even ask that?
Okay, this is where it gets really interesting because this is the core contradiction that Schiff points to. He says that after dismissing the question, the Treasury Secretary made two things clear. One, no tax hikes. And two, quote, we got plenty of money. Plenty of money? When the national debt is sitting at $39 trillion? You see the disconnect. For Schiff, that's the central problem, claiming you have plenty of money while you're already borrowing trillions just to cover your existing bills.
And this is what leads Schiff to draw a really sharp contrast. He looks at how we're talking about paying for this potential war and compares it to how major conflicts were handled in the past. It's like a tale of two completely different strategies.
I mean, just look at this comparison. On one side, you have World War II. Back then, there was no hiding the cost. You had the victory tax, everyone knew they were paying it. You had war bonds where citizens voluntarily loaned money to the government. The sacrifice was real, it was tangible, and it was shared. Now, you fast forward to the approach Schiff describes today. It's the polar opposite. No tax hikes, no cuts to other programs, you just add it to the tab. Put it on the national credit card, which is already completely maxed out.
And this really gets to the absolute heart of Schiff's argument. He's basically saying, listen, everyone is looking over there at the foreign adversary, but the real threat, it isn't out there. It's right here in Washington, D.C. It's the debt. It's the inflation that comes from that debt. That, in his view, is the real enemy we should be worried about.
All right, so now Schiff takes a bit of a turn. He zooms in from this big picture economic policy to a very specific and kind of wild series of events that happened over a single weekend. And this is where he starts raising questions about potential market manipulation.
So check out this roller coaster of a timeline he lays out. On Saturday, the president drops this tough 48-hour ultimatum on social media. Boom. By Sunday, the markets are freaking out. S&P futures are down. Oil prices are way up. Then early Monday morning, a complete change of tune. A new post talks about productive negotiations and a pause. And what happens next? The markets do a complete 180, with the Dow reportedly surging over 1,000 points.
But here is the real kicker. This is the detail Schiff absolutely zeroes in on. He highlights reports of these, well, mysterious large trades, massive bets in the S&P and oil futures markets. And the timing? They were allegedly placed just 5 minutes before that market-moving post went up on Monday morning. The timing is, to say the least, highly suspicious.
Which leads us to the core question Schiff raises about this whole sequence of events. Was the president just reacting to the markets, trying to calm everyone down after seeing the negative reaction? Or, and this is the provocative part, was this a deliberate pattern designed to move markets? It's a heavy question, and it's right at the heart of his analysis.
Okay, so from the high drama of the markets, Schiff pivots again. Now he wants to talk about the economic data that he believes is screaming a warning about what he sees as an impending inflation crisis.
He argues that we need to stop looking at the usual numbers, like the CPI, and instead focus on import and export prices. So why does that matter? Well, because it's raw, unfiltered data. There are no hedonic adjustments to make things look better. It doesn't account for you switching from steak to hamburger. It is just the raw price of stuff coming into the country. He makes two critical points. First, this is the exact same indicator that shot up right before the last big wave of inflation. And second, the numbers we're about to look at, they don't even include the full economic impact of the new war.
So here's the key number from his analysis. For the month of February alone, US import prices jumped 1.3%. And remember, this is before any of the major conflict-related price shocks really hit the global supply chain. 1.3% in just 1 month.
Now you might hear 1.3% and think, that's not so bad. But as Schiff argues, that's not how you should look at this data. You have to ask yourself, okay, what happens if that trend continues for a whole year? What does that number look like when you annualize it?
And here's the answer. That 1.3% monthly jump translates to an annualized rate of 16.8%. Let that sink in for a second. According to Schiff, this shows a massive inflationary wave is already baked into the system, and that's before the full costs of war even start to ripple through the economy.
So this brings us to the final piece of Schiff's argument. He ties all of these threads together, the funding, the markets, the inflation data, and starts to speculate about the underlying political motivations that he thinks might be at play here.
He lays out this theory of a political scapegoat, and here's how he claims it works. Step 1. The economy was already showing signs of trouble with high inflation already baked in. Step 2. A foreign conflict gets started. Step 3. This new war is then blamed for all the negative economic news. And the final outcome? The administration gets to deflect responsibility for problems that, in his view, were already there to begin with.
And to be clear, Schiff adds a really important nuance to his argument. He says, look, even if the war wasn't deliberately started to be a distraction, it will absolutely be used as an excuse. When economic turmoil hits, the war becomes the perfect scapegoat. So for him, the political usefulness of the crisis is the same either way.
And so we end with the central, challenging question that Peter Schiff's analysis leaves us with. When you look at the way it's being funded, the data he points to, is this conflict an unavoidable necessity? Or is it a politically convenient crisis, a perfect way to provide a simple story for complex economic problems that were already brewing long before? It's definitely something to think about.